Joining us in studio to share his analysis on the day's market performance is Jordan Toy from Legacy Family Wealth. Jordan, thanks so much for your time this afternoon. As I mentioned, markets are in the red, and for once President Trump is not to blame. We are seeing tensions in the Middle East really increasing and weighing on sentiment today. Are you watching those developments closely? Just yesterday I spoke to an analyst and he had said, it's nothing to worry about. 24 hours later, what a big difference.
It certainly is something we're watching closely. In terms of the impact, we'll have to see where things go from here. I mean, it is obviously an increase in tensions in the Middle East, but it's not that it's been, completely calm in that region for quite some time. I mean, Israel and Iran were sort of attacking each other in the last couple of months as well. So this is definitely an escalation. And naturally, we're looking at its impact on the oil price. But it certainly is pleasant to not be talking about tariffs every other day. So in terms of the impact on oil, naturally what we're seeing is, Iran is a relatively large oil producer. They are by far and away not the biggest globally. So we're talking less than 10% of global production, but they are in the top 10 in terms of global oil producers. I think what's more significant and what you're probably seeing a bit of in the price is, do these tensions get to the point where the Strait of Hormuz gets closed or potentially shipping is starting to slow down there, because you have the Persian Gulf and a number of these oil producing countries are exporting their oil out through that narrow strait. And there we're talking, 10-20% of global oil production on a daily basis. So that is a much more significant risk to the oil price, at least to the upside. So that's why I say it's key to see. Obviously, Iran, as I understand it, had retaliatory strikes this morning. I think it would be quite a big leap and obviously massively disruptive globally if Iran did choose to start sort of threatening shipping through that narrow passage. We're seeing locally, obviously, Sasol up quite strongly. Around, I believe it jumped to about 7% up this morning. I don't know where it's settled now. I think it was a little bit lower than that. But naturally a benefit to Sasol. So, a lot of their products are linked to or priced based on the prevailing oil price. And I mean, they've talked before about a $1 increase sort of per barrel of oil leads to hundreds of millions of rands on their bottom line.
Yes.
We'll have to see how long this price increase is sustained, because from a downward pressure side, we know that Trump wants lower oil prices, right? We also know that OPEC has been increasing production recently. So is this a short-term sort of flash in the pan where oil spikes up and then sort of starts trending back towards its recent averages? Or do we see an increase or an escalation in tensions in that region that could lead to a more sustained increase in the oil price?
And that was going to be my next question, whether these prices, these high prices are sustainable. The last time I checked, the oil price was trading above that $70 per barrel mark, right? And you mentioned Sasol, I see it's up 6.5%. Also, is that price increase sustainable? We also know that Eskom has other issues. They're dealing with issues over in the US at that chemicals division. So are we perhaps, should we not be too quick to, make a call on Sasol?
Definitely. I think, and you can see it across the energy complex, right? You have an oil price increase, all these sort of energy companies benefit off the back of that, which is largely expected. You mentioned Lake Charles, and I think that's a key point because, and probably for most oil producers globally, oil at $60 to $65 a barrel is on the lower end of where they're actually sort of covering costs and starting to make decent returns when sort of producing the oil. So specifically Lake Charles, we need, or these producers need oil, say 70, 75 plus dollars a barrel, probably closer to 80 arguably, for them to be in a decent position and where it makes sense for them to produce oil. But again, you've got the supply and demand imbalance, right? The supply is increasing out of OPEC. So, does that counteract any short-lived increase in oil prices? I think central bankers are probably waking up with a headache this morning because, the oil price has been a big help in terms of the lower inflation we've seen recently, specifically South Africa. I mean, we import most of our fuels, so it's quite a risk to our inflation forecast. But I think largely the Reserve Bank has looked at that. We know that the Reserve Bank in their recent communications has said we expect inflation to sort of tick up in the short to medium term. So we'll see where it goes from here. I think it's far too soon to start reading through that, okay, we're going to have a sustained increase in the oil price.
I wonder then, what does a weaker rand then do to that equation as well? If we are seeing, sustained higher oil prices as well as a weaker rand dollar exchange rate, more pressures to inflation, right?
Certainly, if you can have the rand and oil offsetting each other. If they both sort of move in the wrong direction, it's obviously a double whammy where we're now importing even more inflation, not just on the oil front, but in terms of other imports. So it's always difficult to try and look and read through why is the currency moving the way it is, but certainly something we'll keep an eye on to see, we have this impact on the oil front, what is the rand doing as well? Mm-hmm.
Now we're seeing a rush to safety and gold, of course, benefiting from that. Jordan, what have you made of precious metals safe haven appeal? It does seem like we've been seeing a rush into the likes of silver and platinum as well, just because the gold price is really high at this point.
So specifically gold, we've seen gold has had a great run over the last couple of years. It's at all-time highs or close to all-time highs. But a big part of that, obviously a big component is retail investors purchasing gold, right? As you said, uncertainty. When we see uncertainty, we see increased purchases in gold, both physical and ETFs, whatever the format be. But a big component of the price pressure in terms of the increase in gold price has been central bank gold reserves, right? We know that over the last 2-3 years, central bank gold purchases have increased quite significantly. More recently, this has tapered off somewhat, but there's been this trend for central banks to increase their gold reserves, right? I don't think that's purely off the back of increased uncertainty. I think it's more of a reserve asset perspective, and we can start talking about the dollar in terms of reserve assets. But so I think that's had a significant impact on the gold price, right? Whether that's sustainable in the long term is a big question mark in my mind. But it's a knee-jerk reaction, right? We see global uncertainty, we see the gold price move up. I would argue that, yes, maybe uncertainty is at somewhat increased levels recently relative to the long-term average in terms of tariffs and now the news as of this morning out of the Middle East. But we always operate in an environment of uncertainty. Was uncertainty less when markets were crashing in 2008? And all I'm ultimately getting to is the headline is always, global uncertainty, gold prices doing well. But we're investing by its very nature is trying to predict uncertain outcomes in the future. So I would be hesitant to say, uncertainty's increased, we should be investing in more gold.
Okay. Let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on some counters that have been attracting interest from your industry peers.
Standard Bank, we do still like the banks. We think they're an incredibly well-managed sector in South Africa, always have been. Standard Bank and FirstRand do stick out. Standard Bank just a little bit cheaper. It's trading on a PE of just over 8 times, dividend yield of about 7%. So, quite a bit of the South African Inc. stocks are trading, at those type of multiples. And we think now's a good time to get involved in some of those blue chip banks.
Well, my stock pick is Premier Foods. They've had released results very recently. Very good set of results. And they are part of the core staple diet, especially in South Africa. If you look at the likes of Iwisa and Blue Label bread. So, they staple foods. They've managed to cut their costs and increase their operating margins. And their financing costs, they've managed to also drop that a bit. I think well managed, growing quite substantially well, slowly but surely, and that's why I'm going with them.
So our analysts going local there with Premier as well as Standard Bank. What do you make of those counters?
So just briefly to touch on Standard Bank, as your guest mentioned there, it's a very well-developed sector in South Africa. We have great financial institutions and we have a very well-established financial sector. So I think that's the first thing. Our banks are also very tech-savvy, so we have great online systems, arguably better than some developed countries, I would say. I think it becomes a question of the opportunity set, right? So Standard Bank is a great business, but when we look at, all right, if we're looking to invest in the financial sector, you've got a range of options, not a massive range of options, but on one end you've got the likes of Capitec, which I think most peers in my industry would argue is the most compelling option. However, it's quite richly valued because of that demand for the share. On the other end, you've got the likes of Absa, which has had recent troubles, more attractive valuation. And then you've got the likes of sort of FirstRand and Nedbank and some of the others in the middle. So I think Standard Bank is a good business. I think it becomes a question of what, based on current circumstances, are the most attractive investment opportunities in that sector. And I would argue that there are other options as well. Mm-hmm. On the Premier Group, as your guest also mentioned, we had results out earlier this week. Great numbers out of Premier Group. I think the brands that they sell are arguably more well known than the business itself. Yeah. Premier Group being the name. And revenue's up 7%. It was just strong numbers across the board. I think what was quite pleasing to see is that they've invested quite a lot of capex, or they've spent a lot of money on upgrading some of their bread making facilities. And you talk about it being a staple, right? And certainly most of their products are, but it becomes an environment where the margins on those kind of products are very narrow. Having said that, when they're spending this kind of money to upgrade their facilities, if you're making 8,000 loaves of bread an hour, and you can save a fraction of a cent per loaf of bread, that can have massive impacts on the bottom line. Mm-hmm. So I think it's good to see that they continue to spend to upgrade their facilities, and hopefully, and you did see that in the numbers recently as well, some margin improvements and some debt reduction. So a great business. And
I mentioned this to Otto when I spoke to him about Premier. It was interesting to see how in the revenue, it was up single digits, but in the in the bottom line, it was up double digits. And they mentioned, also some headwinds faced on the back of prices within soft commodities. So there also volatility when it comes to that as well.
Certainly. So cost control is key, right? And especially in these low margin businesses, your revenues can be relatively flat, but if you're managing the cost base really well, you can still have bigger increases out of your profit or your bottom line.
All right, let's get your stock pick. Where are you seeing opportunity at the moment?
So a stock pick I wanted to talk about today is Meta. Not necessarily from a pure valuation perspective of where it currently trades, but more from a longer term perspective around I really like the positioning of the business. I think if we look at the longer term trends, the amount of time every individual spends on their screen, whether it's a smartphone or a TV nowadays, is going one way, and that's up, right? And it's a question of who's getting the share of that screen time. The likes of Netflix, sort of in the streaming and TV space, is obviously doing quite well. But in terms of social media and advertising, Meta is by far and away, one of the largest businesses in that space. The margins in that business are absolutely massive. And we're seeing them also spend significantly to be one of the key players in the AI space. Arguably, they haven't had huge success on that yet, but I think one of the early cases of can we see AI systems being monetized, not just AI for the sake of it, but actually translating to additional revenues. And you can imagine in the advertising space, it's well known, adverts are targeted based on your views and what you like seeing. And Meta is arguably very well positioned and is already doing so, right? That they are serving up more focused ads based on your interests. And can they continue to capitalize on that? We saw news this week that Mark Zuckerberg's quite frustrated with their progress there and is spending even more to build the super intelligence unit. And they've invested in another company to bring across that CEO to sort of enhance their AI efforts. So I think when we look at it from that perspective and the longer term trends, I think Meta continues to be well positioned.
All right, so Meta one to look out for, even though it's really expensive. But I'll let you be. Jordan, thanks so much for your time and joining us this afternoon. That was Jordan Toy from Legacy Family Wealth.